Morning all, here we are on the Flow Show. It's Tuesday, no K Meister today, but we do have Stelios in the house. Morning, Stel.
Hello, good morning, everybody. Can you hear me? I've got some new headphones.
Yeah, we can hear you fine, mate. Yeah.
Excellent. Still the same annoying voice, but you can hear me fine. Great.
There's apps for that now, mate, if you want to change your voice.
Yeah, how
We
you
should
doing,
do that.
mate? You good?
Yeah, all good, mate. We should do that one day. Come in with funny voices on.
I don't need to do anything. I have a funny voice anyway. Yeah, mate.
Good stuff. Good stuff.
Ah,
Right, well, a bit of a quiet day yesterday, but some headlines still floating around, so we'll crack open on those first thing. Obviously, at the China meeting, Blinken over in China there, and some reasonably positive headlines. Probably, well, they weren't actually any bad headlines. China Z believes that US and China can overcome difficulties. That was reported by Xinhua. Apparently, he told Blinken that very good progress was made on US-China ties. Later on, US President Biden came out and said that US-China relations are on the right trail. So a little bit of easing, shall we say, of tensions. But Blinken did make it clear that the US still thinks China are up to no good, or are drawing some strong lines in certain areas, particularly like Taiwan. So he made it clear that what the US's position on such things were. So platitudes all round, but nothing concrete in terms of real easing of tensions. They are open to more meetings, China officials going to the US and more higher level officials going to China. So let's see what that potentially brings over the months ahead. Meanwhile, on the monetary policy front, the PBOC went ahead and cut the LPR rates. The 1 year was cut by 10 pips, and the 5 year was cut by 10 pips also, although that one was touted that it might be cut by 15 pips on the 5 year. So that pretty much concludes a round of rate easing of all the different little rates they've got over there for this month anyway. Still touted more to come. Whether they follow up month by month or give a bit of space, we don't know. We'll have to wait and see. But they're still on the easing path. That helped dollar China up, though it couldn't quite get up to the recent highs. We did get that move up though in the rates. Was expected, so a bit of surprise to see a little pop there. Probably a confirmation move. And they're going to continue easing and opening up the fiscal purse on things like property. So the green light is still in play there. The fix is still following the price rather than trying to put a brake on it. So again, more green lights over there for these moves to continue. But we need to see what happens up at these highs to see whether they can get taken out or not. Over to Japan. And Finance Minister Suzuki said that the removal from the US FX watch list won't immediately impact on Japan's FX policy. This was to do with the, I think it's a biannual report that the US issue, the Treasury issues, about those who might be up to no good in their FX markets. A few countries are on the watch list that came off. Japan was one of them. Obviously, they did a lot of explaining at prior G meetings and whatnot as to why they were intervening and so on and so forth. So they got taken off the list. He also said that if necessary, we'll take appropriate action on FX policy. So same old lines from him over what's going on in the yen. Over to the RBA, and the minutes were out from their last meeting. Broad Stroke said that the economy still looks to be on a narrow path to a soft landing. There's no sign yet of services inflation moderating and may indeed persist. The last rate hike was based on inflation taking longer to hit target. And the recent data suggested that inflation risks had shifted to the upside. Keeps them on the hawkish foot. RBA's Bullock was out later saying higher rates are the only tool the RBA has to bring down inflation. The S&P is up on the docket as well this week with a rate announcement. And maybe surprisingly, and I think maybe the market might be underpricing this somewhat, 30 out of 33 economists polled by Reuters said that they expect the S&P to only hike by 25 pips to 1.75% this week. This meeting comes just before the Bank of England announcement. On the rate probabilities, we're pricing 58.4% chance of a 50 and the balance being a 25 hike. Now, remember, these guys only meet once a quarter. So I think 25 might be on the low side for this one. Rates at 1.75%, well, or would be at 1.75% for a 25 pip hike, well below pretty much everyone apart from the Bank of Japan. So I think those economists are perhaps leaning a little bit less hawkish than they should be. And we'll see what happens anyway. If the market is leaning that way also, that gives a bit of a shock price move if they go a 50 perhaps, and we see Swissy gaining a bit on that. Looking at the Swissy at the moment, still keeping its bids, or Swiss pairs keeping their bid, Euro Swiss particularly, as Kay mentioned last week. If the market's expecting 25 and they go a 50, that potentially gives a dip, and even he might be tempted to get into that one. I think I'm going to keep an eye on that as well. Decent dip in that one might be worth jumping onto. Over on the data front, and we got some German PPI this morning. Oh, where's it gone? There we go. German PPI month on month coming in lower than expected, down 1.4%. Year on year, still a positive number, but not climbing as high as it was previously or as expected. So continued easing pressures there as well. A few bits and pieces of data out from Japan as well. Industrial production coming in up 0.7% month on month, was expected to dip by 0.4%. Capacity utilization also up a healthy looking 3%. So once again, data a bit mixed in Japan. Some things up, some things down. Just looking back quickly at yesterday's US housing market index, continuing to improve. This had taken a real battering over the last year or so, and it moved up to 55 from 51 expected and 50 prior. Swinging back to Europe and the ECB. ECB's Lane was out with a choice comment yesterday. Now, you have to remember, ECB's Lane is the chief economist at the ECB, so you think he would know what's going on. He says inflation will come down fairly quickly in the next couple of years to the ECB's target, which then you'd have to ask, well, why did they raise their CPI forecasts if they saw inflation coming down that quickly? And again, from the chief economist, the ECB sees the rate coming down, yet was happy to sign off on marking up the CPI forecasts. Anyway, I'll let you decide what to do with that one. He also said another hike in July seems appropriate, and then we shall see what happens in September. ECB's Schnabel said risks to the inflation outlook are tilted to the upside. The fact that we underestimated inflation persistence last year raises the probability that we are also underestimating inflation today. Our mate over in Greece, Stornomas, said, I cannot exclude a further rate rise, but we cannot say now. We are data driven. And he was asked about keeping rates at a terminal level, said might be 6 months or a year. It depends on the data. But said we are definitely close to the end of interest rate increases. ECB's De Guindos expects inflation to ease, but the core may not fall so quickly. And this morning, Ollie Rehn, ECB's Rehn, said underlying inflation is easing only gradually. Not to be left out, following Bank of Italy raising their growth forecast, the Bank of Spain raised their forecasts for 2023 too. They now see GDP at 2.3% from 1.6% prior, so a similar uplift in size from the Bank of Spain. They also cut their HICP inflation forecast to 3.2% from 3.7%. So not as high a level as in Italy in the 6%, but still way above the ECB target. If you can call it this, a bit of price pressure easing in the UK. Grocery inflation, annual grocery inflation measured by Kantar, came in and for the last 4 weeks at 16.5% versus 17.2% prior. So only a 16.5% increase in the last 4 weeks. But that is the third dip off the highs on the chart, which are up around 18-19% previously. There's been some strike or wage negotiation news as well. One of the UK's big unions, Unite, said that workers at the BP Petrofac plant have agreed the equivalent of a 9% wage hike. Now, this doesn't relate to a hell of a lot of people. I think it's about 90 people this relates to, but it's still showing you the level of wage negotiations and wage deals being done. 9% for those guys. Still plenty of strikes and plenty of wage negotiations to come, which are all going to feed through into inflation further down the line and going to keep wages very sticky for the UK. That's it from the headlines. US holiday yesterday, so not a lot going on. I don't know if Still's got anything he wants to add in, and I'd ask about the SMB and this 25 pip call from economists. Seems a little low, mate.
Yeah, the S&B is a tricky one. I can never get, well, I can't get inside anybody's head, but the S&B is, for me, the trickiest of central banks to figure out. Do I think there's a decent chance of more than 25? Yes, I do. But I've been saying this for a while, and we saw the ECB following route, actually. As soon as the Fed goes, yeah, we're skipping, I think in reality they're pausing, but they're saying we're skipping, we're going to be fully data dependent now, etc., etc. Look, the ECB's following suit, even though their inflation is over 6% and the US is 4%. So, the Fed leads the way. So I've said this for a while. I stand by it. I think that now that the Fed is effectively paused, or maybe one more and then they pause, but I think everybody's going to follow. So do I think 25 is... Do I think there's a risk of 50 for the S&B? Yes, and I think the most logical thing would be for them to do 50, but because all these central bankers, they speak to each other and they're always dovish by nature, I think a 25 is the most likely scenario. So what's the market pricing? Is there a kind of like overnight index swaps or something we can look to see what they're pricing for the Swissy? But
yeah, well, the rate probabilities, which are priced off of what they priced off of, they're probably priced off something like OIS.
Yeah, OIS is yeah.
He's showing a 58% probability.
Okay.
Of a 50, yeah.
Yeah. Yeah, I don't have much faith in central bankers, unfortunately, and I've said it before. When they have a choice, they will invariably go to the dovish side. So I don't know what to make of the S&B, man. Seriously, I don't know. But the ECB is slowly turning as well, and they're telling us, yeah, we're going to be data dependent, etc., etc. And I think we're really close to a top in rates. And I was speaking to some friends who are not traders, but they know about markets, and they're all saying these are really attractive levels to get yields. The US, even Germany, 1 year Germany is 3%. Not a bad little yield to have with zero risk. And I think a lot of investors are looking at that, and I think for yields to go higher than here, and I mean significantly higher, it's going to take something big. It's going to take inflation kind of ramping up again or something like that, which I don't see happening. So I really think we are at the top in yields. 3.90 in the 10-year US is what I've been looking at for a while. We're not there, but close enough.
Yeah.
Yeah. I don't know. I think yields obviously drive many markets, and I think that yields are very close to the top now. They look attractive any way you look at it. And you know what happens if there is any kind of crisis or black swan scenario, bonds get bid straight away, or if there's a very strong risk off move, bonds get bid again. So for me, there are few scenarios where yields go higher than here. Of course they can go higher, but there's only a few and low probability scenarios for me for yields to go higher.
Yeah, no,
sorry,
I agree with
I
that.
digressed. You asked one thing, I talked about
That's
10.
right. You can go on a little wonder, mate. No worries. No worries. But no, I think you're right on yields. I mean, over the last few months, I saw it as a pretty high bar for us to get up into that, looking at something like US 10s getting back up into that 4% area. Because there's just we knew the rates hikes were coming to an end. For me, the only way yields really get up that high, and remember, if yields are going up, it means bonds are being sold. So people are getting out of bonds. So it would really only be a risk play, in my opinion, that would see yields go up, because traders are moving out of the safety of bonds and into higher risk assets and investments like stocks. So I think that's really the only way we'd see yields going back up, or unless there's some sort of blowout crisis or something that just sees interest rates rocket, something like that. But yeah, it is a high bar, and it's looking at US 10s. We've got three potentially decent tops here. We're making lower highs, and we're just creeping lower on the lows. So it does insinuate that the path might be lower for yields. But then if rates are holding up, we should probably expect a bit of sideways action and a bit of ranging coming in there.
If you look at this chart, sorry to interrupt, you look at this chart, I mean, this looks like a bullish flag, right? But for me, so if you show me this chart and I don't know what it is, I'll say, yeah, most likely this is going to be going higher. But for me, the macro backdrop and the macro, environment tells me that the most likely scenario is that this actually resolves to the downside. But technically speaking, this is still a bullish formation. Yeah. Technically speaking.
Yeah. We shall see. One of us is going to be right or wrong, or we'll both be right or we'll both be wrong. Such is the magic of trading. But yeah, just popping back and just talking about the S&B again. And I'm wondering if I might keep an eye on pound Swissy. I know a few of our guys in the room like trading this one. Might be good for a quick 1-2 trade over the S&B and the BOE. If the S&B do go a 50 and surprise the market, we should see this one dipping quite a bit. And then if the Bank of England is going to be hawkish and indicate they're going to have to do more than expected, this one could bounce pretty quickly. Obviously, got to be careful of that CPI data tomorrow, which is going to force me out of bed half an hour early. The buggers, 7 o'clock data. I should be shot for that. Anyway, yeah, keep an eye on pound Swissy, and if any of you guys and girls in the chat here today got any levels you want to have a look at or of interest to you, then let us know. But that might be one for a quick 1-2 trade over the SMB and the BOE. Right, just having a look at some of the other pairs, and then I'll hand it over to Stelios shortly. And again, talking in the room today, yesterday, one of my levels was 142.20s, which was this November high. After we had the breakdown from the 145s, we bounced, and that's where we found resistance. I had this level on here more as a watch point, and we pretty much hit it nail on the head. 142.24 was the high, and then we've been pulling back ever since. So one of these, as I say, not a level I'd trade, but it's one of those, will something happen there? And something did happen there. Now, what are we going to do from here on in? Oh, let's give it that bugger. Where's it gone? Oh, go away. There we go. Come, get rid of it. Right, I'll leave it there for now. Anyway, we've got a bit of a pullback. And actually, I was looking at this 40 area, and looks like I've missed it. That was my level that I touted in the room earlier as the main support point. We've hit it and bounced back to 60s. If we break there, then we're looking at 141s, 140.90s, and then down 144, 140.60s perhaps. But at the moment, we've held that. 142, I suspect, is going to become resistance once again on a bounce. So watch out. We may have just seen this as a bit of a stop run, barrier blast, whatever you want to call it. Then we had a steep pullback overnight. Bit of following the Nikkei still on that. Bounce back above and come back down. So we've got a bit of indecision going on here at the moment. But we're holding where we need to hold on the tech front. So while this 40 level holds, may see a bit of a play between there and the prior highs. This one smells a bit like a bit more of a dollar move, because yen pairs in general are still holding up pretty well. It's not wholesale. We're seeing big wholesale moves off the top, but holding up nice enough, but dipping as well. So something like Aussie yen is having a bit of a steeper pullback. Got a bit of a break point here around about 95.75. That's a bit of a, as you can see there, bit of a historical level, marking a bit of a range as well, range top. So if you're looking for a pullback in the Aussie against the yen, 95.70, 75 is where you want to be looking at for that one. This move again couldn't quite get up to the prior high, which again makes it a bit more tougher now to see a break, because we're coming up short of that test. If we'd have broken even above by a few pips, would have kept this move going, and potentially leading to bigger gains there. But as I say, if you're trading this one, you probably got a good playground to play in now between there and the highs up there. Euro dollar, it's had a pullback as well, but it's a bit slow going, and it's not a lot. We're still keeping our nose above the 109 handle, which is important in the short term. Our old mate up here, up at the 109.40s, playing hardball again. So keep an eye on that. Bit of an intermediate level around this 20s, bit of a short-term pivot level. Just keep an eye on that one as well. But 109 down to 109 up to 109.10 is where the key support is for now. As I say, not moving a lot. Cables moving a bit more. We've had a bit more of a pullback in size than we've seen in the euro. We're under 128. Bit of support around this old fib level, 127.60s. Call it up to 70s as well. As you can see, we're mooching around there. Again, you probably want to play this one on the big figures and half figures. So 127.50, probably going to see some support, 127, 50 pips, so on and so forth as we go down. Now, because this one is doing its usual volatility trick, i.e. it moves more than the euro does when it moves, that's giving euro sterling a little bit of a lift off the bottom. Creeping up to 85.60, 85.70, a bit of a level, previous old level that we had on the way down. Now it's mooching around there again. You know, it breaks, it holds, it breaks, it holds. So that's an area to keep an eye on. But again, it's going to be 86, 86.10 is the next main area up there. I think it might be a bit of a push to get this one up there. I wouldn't be surprised if we did see it rising a bit more. Perhaps some players taking some shorts, taking some chips off the table ahead of the CPI report tomorrow, and obviously the Bank of England the day after. I'm still short in this one. I didn't quite get close to 85s to knock some out, which I was looking to do just ahead of the data. So might be we're in a bit of no man's land going into the data, but I'm not expecting a huge rally in this unless CPI falls out of bed and the Bank of England don't hike or aren't as hawkish as I expect them to be. But could be a case I'm just going to be seeing what happens over the data and reacting to it as it comes. Stel, did you want to grab the reins?
Nope, I'm kidding.
Okay.
Of course. I will grab them by the reins.
Let me
Share
pass
screen.
over to you. There we go.
Oh, this is the first time I'm sharing on this new laptop. Oh, open system preferences. Hold on. I need to allow Zoom to share my screen.
No worries, mate.
Sorry, this is
I'm glad we tested this before you tried it.
Yeah, of course. Hold on. Sorry, give me 1 second. Add. Oops, no. Bloody hell, screen.
Well, while you're doing that, I'm just going to answer Mike. Do I believe dollar yen is a buy on a dip? Well, it certainly seems that way at the moment. As I said, I did flag the 1 for 140 area in our chat room this morning, and you could be 20 odd pips up on that one for now. So, yeah, I don't see any reason why the trend should change. But it's all about the highs, really. Do you want me to grab that back for a minute?
Zoom will not be able to record until it is quit. So I need to quit and reopen Zoom. Okay, so give me 1 minute, grab it back, and I'll be right there. Okay. Sorry about that.
Worries, mate.
Sorry about that.
Let me grab it. Okie doke. So yeah, just I need to get rid of that thing. Give me 1 second. Let's go somewhere where I can grab it. There we go. Right.
Okay, I am back. I'm going to try sharing my screen again. Hold on. Okay. Sorry about that. I should have done that before. Continue. Oh, desktop 1. It can see it. You can see this, right?
Yeah. There we go.
Perfect. Sorry about that. Okay. For me, we're still in a holding pattern. The main question remains the Fed and are they done or not? And by definition, or by extension, all the other central banks slowly follow. I still think we're done, although the majority of the market has another hike priced in, and then a cut by early 2024. I think those cuts, unless there's a big crisis of some sort, they're not going to come. There's no reason for them to be cutting. And I don't think that CPI is going to be printing negative. So barring a big surprise, I think they are paused and they will stay there for a while. So yields, starting off with that, I've talked about this at length. If you zoom out, like we saw before, this is still a bullish pattern. I mean, big impulsive move higher over the past year or two, and then non-stop as well. I mean, the pullbacks were tiny, and still this looks like some kind of bullish flag. But I do think that central banks are done, and I've said this before, yields are starting to look quite attractive. And I think investors, and mostly investors, but traders as well, they have seen 10, 15 years of no yields. And now that we're getting yields, and it looks like we might be peaking out at some point, I think they're more and more going to start piling in to grab the yields while they're there. So I'm personally looking for it was 390, it's probably a little bit lower now, 380, 788. I know it's only a few basis points, but I like to wait for markets to come to where I think is the right level. When we get that, I think I'm going to get long the 10-year US, unless we've seen a big upward surprise in US CPI, which means then that all bets are off. But I do think that CPI, both the headline and the core, are going to continue to grind lower, and the Fed's going to be done. So yields, this is my plan. I want to buy 10 years or sell yields at 387, between 387 390. I think we're going to have another leg lower, and I think these lows are going to break. So if yields don't go higher, that theoretically is good for risk. Excuse me. It's usually good for risk. Now, having said that, though, we've gone up, in orders of magnitude in yields comparing to the last 15 years over the past 2 years. And if you take out this COVID blip, which was really in the end a blip, if you take this out and you just draw a straight line, stocks have not done anything. If anything, they're close to their highs, their all-time highs. And with yields rising this quickly, theoretically, stocks should be facing some headwinds. So with if yields drop, as I think they will, does that mean that the risk gets bought and stocks rally? Maybe in the short term, but I think overall, we are still quite overvalued with if you look at various metrics, stock prices are inflated. There are 4 or 5 big names that are pushing the equities, and the vast majority of the rest are down on the year. So I'm not as convinced about stocks. Having said that, what have I been saying for weeks now? Do not go against this trend. This is an impulsive move. We had a clean breakout. We've gone straight up. Yes, of course, if you're a day trader, you can get short and do well. But if you're not, I mean, this is still a very strong move, any way you look at it. Support is difficult to say. I think the first, realistic support is somewhere between 43 and 43.20. And then the big support is obviously 4,200. But until we reach that 43 to 43.20 level, this is still bullish, any way you look at it. And if yields do go down, then there's going to be some short-term strength coming to risk. That's the logical scenario, and that's what the markets do and what they've done for ages. And now that we have algos driving 80% of the flow, it's all correlation algos, and one moves the other, etc. So I wouldn't go against this move now, even though it looks like we might be having a short-term top. It just, for me, doesn't tell me anything bearish yet technically. The DAX is similar. I mean, we took out new all-time highs, we're correcting, but still same, just a straight line with small dips, and it just keeps going. So do I want to go against this? Of course not. Am I saying buy it here? No. Again, this is not a place to be buying unless, we hit new all-time highs. One of the most bullish things that can happen to a stock index is if it hits new all-time highs. So if we do that, then yeah, I think it's becoming even more bullish. But at the moment, it's just not bearish at all, in my view. For the DAX, we need to break below this 15,600, which is these lows, these highs here. Now, this is a pretty important level here. Until then, it's still, in my opinion, is still looking strong, and I wouldn't go against it. The dollar is, well, it's weakened over the past couple of weeks. It's trying to bounce, but the bounce is looking relatively feeble. We're at the 50 DMA, which it did cap it today. I still think these lows are going to get taken out, and the dollar just doesn't look strong in any way at the moment. And if the Fed does continue to do what I think it's going to do, then these lows get taken out relatively quickly. I think the next meeting, if they don't hike, that's it. But the dollar is maybe ripe for a little bounce, but it's just, it's trying to bounce, but it's not really, it's not convincing in any way. Mark Chandler has been talking about that, and he thinks that we might see a nice little bounce from here. I'm not convinced. I'm really not. So the euro dollar, well, it's the opposite of the Dixie. So I think that these highs, 110 and whatever that was, I think those are going to get taken out eventually. I'm not touching the euro dollar here, and I'm not touching the Dixie. I want to see a technical breakdown in the Dixie before I do anything. But my bias is to be selling rallies in the dollar. That's still my bias, and it will remain until something changes from the Fed or from wherever. So I want to be a seller of rallies in the dollar. The cable is looking better now. We're talking about this channel which broke out, but then it was kind of trying to break out, but not now. This move, well, the dollar has been selling off against most majors, and it's looking relatively strong, well, actually quite strong. 126.8 I have as support. But again, this is a pair I want to be buying on dips. Sterling, I think, is going to continue to do well during the rest of the year. It's going to be one of the currencies that outperforms. I've said this for weeks now. Euro pound, well, that's just purely bearish here. It's gone in a straight line. I don't see any reason why to change this view. Yes, today we're up a bit, but overall, it's still quite bearish. And I wouldn't, if you're short, I wouldn't touch it. I think we're going lower. I think 83 and a half is the target. And I think we might get there relatively quickly. You know, we have the Bank of England tomorrow. Let's see. Yeah, I'm not saying we're going to get there tomorrow, you know, but it's something that I think has more legs to the downside. We talked about risk cryptos, risk proxy, the usual, still underperforming, and will continue to underperform, in my opinion. So I'm not going to change anything in that. In my view, we are at the 50 DMA. There's this descending trend line resistance as well. Yeah, it doesn't look strong any way you look at it. And I do think that stocks eventually going to reverse. Not yet, but even with stocks doing well, okay, today they're down a bit, but overall the path has been good. Even with the stocks doing well, Bitcoin has done nothing. So this is really underperformance any way you look at it, and I just don't see any reason to be bullish cryptos. Ethereum is the same story. Broke down these lows, retesting them here. You know, it doesn't. You know, I think this is going eventually lower. Of course, if stocks rally and go ballistic, cryptos are going to rally with them, but they're going to underperform, I think. Metals also not looking great. Oops, sorry, that was my chair. Even with risk rallying, gold has failed to produce anything over the past 2-3 weeks. If anything, this looks like some kind of bearish consolidation after the move from the highs, 100 points lower from the highs or so. I still think it's 50-50 or maybe slightly more than 50-50 that we test these lows, this level here around 1850, 1840, 1850, especially if stocks if stocks find some kind of a medium-term top here, or if the dollar bounces, I think these lows are going to get taken out and we go down here. But overall, I always like to zoom out a bit, and this thing is nothing but a wonderful sideways bullish consolidation, any way you look at it. And if you consider what's happened with rates, which theoretically are a big obstacle for metals, I mean, this has been fantastically strong, and I think this is going to break to the upside, but probably not yet. I still think it's 50-50 for a move lower first. I know I repeat myself a lot in these things, but the way I look at markets doesn't change from one day to the next. Silver is similar. It's been doing a little bit better recently, but still within this general descending channel. I think that a visit towards the low 22s is possible, and we've seen silver underperform a lot when metals drop, and the usual fat finger attacks, they come almost every week now. So do we get to low 22s? I think it's possible. I think it's a 50-50. What do I think in the medium term? We take out 24.5, take out 26, and we go towards 30 and above. That's, I think, for me, there's no doubt. The question is, how do we get there? How do you trade it? How do you manage your leverage, your entries, your exits? So that's the tricky bit. I remain long, one full position from very low 23s, 23.10 if I recall. And I want to add more. This is one of the rare occasions, I've said it before, haven't done this in a couple of years, rare occasions where I want to go more than one full size long. I'm going to do that if we get towards the low 22s. But I'm still in this trade, in the money, and not particularly worried. The Fed, I think, next month is going to be key for everything. So holding pattern, waiting game for both gold and silver. Gold, the levels are clear. Come on, mousepad. 1930, 35, maybe 1930 to 1985. Clear levels. We are roughly in the middle. Silver the same, 24.50, and mid 22s, I would say. So until then, I am not doing anything. Oil, I've said this before. I don't know how you guys and gals trade this. I can't trade it. It's just taking out big daily moves, up, down, up, down. I have no view. If you ask me what I think happens in the next, few years, I think we take out highs and we go triple digits and beyond. But for now, I think, I will not touch that with a 10-foot pole. Norway, I want to sell it. I missed this. We tried selling dollar Norway and euro Norway with, I think with you as well, Ryan, right? You sold some as well. I got taken out at break even. It went well initially. Then I got taken out at break even, and then I said, screw that. I'm not going to touch it, and I missed this move. Same in dollars. Yeah, I want to sell it again, but I'm not. I don't have any levels in mind at the moment. Dollar CAD, I like this breakdown was clean. I was talking about it before quite extensively. It remains bearish. I want to sell rallies in dollar CAD. This is another pair I want to be selling dollars against other currencies. Any rally up towards 133. Maybe even below 130, 132.9, 133.2. I think that's a range that is going to be interesting to sell. The yen I haven't traded in ages. It's just going higher. I have no opinion on the yen, so don't ask me that. You can ask K-Man for that, or Ryan. That's it. I don't have much else to say. I will give it back to you, my friend, if you're there.
Yep, I'm here, mate.
Okay, no worries. I can speak for more if you need to do something.
No, I'll grab it back. Someone wanted to have a look at Guppy, so we'll do that. Just make sure you can see that okay.
Yep,
good stuff. So Guppy, bit of a strange one, this one, because it's been such a swift move over the last week or so. Really finding where the support points are going to come in could be a bit of trial and error. We've got some, just some of the times where we moved up, held, broke. Those are the points I usually look at. Excuse me, 180, 87s, 70s as one of those levels, but we're under that already. We've got another support point down into 180 that's going to be potentially important too. But some of these levels, they're not something you'd completely hang your hat on. I've got this fib in. I don't often have such short-term fibs. I like my fibs to be at least, over a month old, 2 months old. So this is just a couple of weeks fib. And even that shows you the scale of the move, because a 38.2 doesn't come in until 178. So we're still 250 pips away on that one. And if you take it on a wider view, if you take the whole of this rally or this swing up from March, 38.2 is way down at 173s. So this has been a big, strong move. So it has a lot of room potentially to pull back quite significantly. So if you have got the butcher's gloves on and you're looking to try and catch this knife, pick a dip, you have various levels you can lean on, but I would keep those very tight. Don't give it a lot of room, because you can find this can be down here in the 170s, under 180s, right down here before it even starts to look like it's going to bounce again. So if you're going to get the gloves on, make sure you're juggling with very small knives rather than big hatchets. You don't want to lose any fingers on that one. Euro CAD is one I'm keeping half an eye on. We're doing a bit of ping pong between the levels here. I was hoping a while back to get a move down into this fib, because it's quite a strong area. We didn't get really close to it, and we're doing a bit of ping pong between this 144s and 145s, call it, at the moment. Obviously got the big level above the old 146, 4050 area, hence why it's marked in a big thick red line, because it's been a real doozy of a level, as you guys and girls will know watching this. So it's still a little bit uncertain what it's doing here, but this one is potentially playing nicely with the techs. Right now, while we're below 145, it keeps the pressure on the downside, keeps this trend off that double top in play. So maybe we will get a test down here over the next few sessions or few weeks, maybe. I concur with Stel on the dollar CAD. Bounce is still looking weak. We still can't get above, meaningfully above this 132 2025s. We've had a couple of little pokes above, up to 133.40. Can't hold it. We're staying very bearish on this one, but it really needs to get a hold above 132 2025. If it can hold there, then we may get a move, and still might get his run up to 133s. Again, this one has been driven a lot by what's gone on in the yen, as well as oil, as still mentioned. So it's got several wins behind it at the moment, as to why the pair overall has been weaker. But if we can't break the lows, then there's only one other way we can go, and that's back up. So look for further tests here. If we start finding support around about 132s, see this low stepping up to 132, we might just be seeing that already. That's going to give buyers a little bit of impetus to maybe have a little push higher, and see where we go from there. Aussie dollar undoing all the hard work, really. We got up to the 69s, 68 we've broken under now. That's a potentially strong move if it holds. That would suggest we're in for further downside here. Maybe we get a move down to 67s, which has been another one of those long-term support and resistance areas. We've got some smaller levels in the way, 67 70s, down around 67 40s. Again, just one of those on-off levels. So keep an eye on those as we head lower. But below 68 and holding below 68 isn't looking too hot for the Aussie on that one. I don't know if you guys and girls got anything particular you want to us to look at. As always, put them in the chat here on Zoom, if that's where you're following us. What have we got coming up for us today? We've got some more housing data coming in from the US, starts and permits. So we get to see the health of the housing market for May, some of the hard data coming in from the US. Other than that, not a lot going on for the rest of the day. One thing I did want to draw your attention to regarding the UK, and while I've been fairly bullish over the Bank of England and rates, there is something bubbling here in the UK to do with mortgages. Because rates have been going up, yields have been going up, there's a lot of pressure coming in on mortgages. You may remember I explained what tightening financial conditions really looks like on one of the shows last week. Well, it's becoming a big political football over here now, the level of mortgages, and whether the government should step in and help mortgage holders, which of course they shouldn't. I don't have a lot of sympathy for a lot of people who have been enjoying next to zero rates for the last God knows how long, and now getting stung by rate hikes. It's a complete lack of financial planning why some are going to get caught out, that they expected rates to stay low forever. The UK press is doing its usual thing of, the end of the world is nigh. They weren't touting this 18 to 24 months ago when we were talking about the prospect of higher rates. And the reason I raise it is because it's becoming such a big deal over here in the UK. It could start weighing on the pound, because if investors think that there's some sort of blow up in the property market caused by higher rates, we do have a lot of investment, foreign investment in property over here, which shouldn't really be affected by rates unless they've been borrowing up to the hilt when rates were low. But if there are signs of property troubles, we could see a bit of a correction in the housing market that will impact the pound. We'll see some negativity. Also, it will be playing in the mind of the MPC members. They will be sitting there. That's why Bailey's reluctant to take rates higher, because it's just going to compound the problem with mortgages that is being talked about. So that might be something they touch upon on Thursday, and try and keep a dovish slant or a less hawkish slant to a rate hike, because they won't want the market taking off too much further with hikes, particularly in yields, bond yields and things like that. So just something to keep an eye on, at least on the political UK front, and if you're trading the pound keep an eye on that one as well. And I think we shall call that a day, unless you got anything else you want to throw in, Stel?
I do not. So
No.
thank you, Ryan, for another day of excellent content.
Thank you very much, mate. And right back at you, as always. And right, we shall be back tomorrow, and we'll know what's happened with the UK CPI, so we'll be able to discuss that and see where the pound is. Will it be at 130? Will it be at 125? Or will it be right where it is right now? Who knows? The magic of the quid. Have a great day, everybody. Stay safe over the CPI tomorrow, and we'll see you again soon. Thank you very much.
Thank you. Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.